Okay, folks, today we're going to continue with our tutorials. We're going to go over 2030 target date. This is the State Street 2030 target date mutual fund. Look at the previous videos. You'll see how to log into your account to get to this part of the lesson. So for 2030 target date, it's a little bit different than 2020 target date. It starts off a little more aggressive, a little more risky, and then it gets conservative the closer you get to 2030 target date. So when you look at this fund, on this page, you want to pay attention to the description. You also want to pay attention to the fund objective. So for the mixed asset target 2030 funds, the funds that seek to maximize assets for retirement with an expected retirement date on or around 2030. So since we're about 10 years away, it's still a little bit aggressive. It's tapering down. It's going to be very conservative once we hit 2030. They don't want you to lose your money. They want you to have a lot of money for retirement and stable money for retirement. The fund objective, you can read over that. What I really like for you guys to look at is the historical performance. So this 2030 target date from State Street is comparing itself to the Dow Jones 2030 target date. This is a newer fund, so it's only been out a couple of years. You can see that the 2030 target date for State Street is slightly beating out the Dow Jones 2030 target date. If you look at the little graph here, the red line is where we're currently at. You can see that it's tapering down. It'll taper down for the next 15 years. And then it'll have the same investment mix after that 15-year period. So for right now, you're looking at about 68% stocks, 32% bonds and cash. As you get closer to that 2030 date, it'll move down to about 35% stocks, 65% bonds and cash. So it is tapering down. It will be more consistent after 2030. Look at the expense ratio. Expense ratio is 0.10. Okay, let's look at the overall performance of it. So like I said before, this is a newer fund, so we might not have too much data available to compare it with the other benchmarks. But look at the little graphs. 2030 target date. Year to date, it's a 9.9. It's slightly beating out the Dow Jones target date. It is behind the S&P 500 target date. The S&P 500 is the global benchmark for markets, for stock markets. So 2030 target date is not as aggressive or it's not as risky as the S&P 500. It should always lag the S&P 500. Any of these target dates should lag the S&P 500. S&P 500 is the benchmark for the world. You see the 1-year return? It's slightly beating the Dow Jones. And we don't have data for 3 years, 5 years and on because it is a newer fund. But we can take a look at the Dow Jones target date versus the S&P 500. You see that Dow Jones target date 2030 is not as successful as the S&P 500 because it's not as risky. Okay, let's look at the calendar date returns. Last year, like I said before in the other video, for 2018, there were very few investments that were positive, and that was worldwide. So the 2030 target date, it lost more than the S&P 500 and the Dow Jones 2030 target date. For 2017, 2030 target date for State Street, it outperformed the Dow Jones 2030. You see, it is behind the S&P 500. It's supposed to be behind the S&P 500. Let's look at performance for the rest of the years. Dow Jones 2030 target date versus the S&P 500. That way you can get an idea overall of how the 2030 target dates compare to the world benchmark. S&P 500 should always outperform any target dates. So let's see if that's true on average. Okay, guys, if you scroll down, you can see your growth. If you had a $10,000 lump sum investment, how much it grew over a year. Another thing you want to pay attention to are your fees. How much are they charging you for you to be in this mutual fund? So this one has a 0.1% expense ratio, which is very low. That's a very good expense ratio. You can read some of the other information that's in here to get yourself familiarized with it. But we did go over it in the other video. But just get yourself familiarized with that so you know exactly what they're charging you to be part of this mutual fund. All right. Another thing to pay attention to is the portfolio. So I think in the last video, I forgot to go over like a portfolio. A portfolio is everything that's in the mutual fund. So this mutual fund is probably going to have stocks. It's probably going to have bonds. It might even have some short-term debt, fixed income. Every stock or bond or fixed asset that's in this fund is part of its portfolio. So all of our 2030 target or all of our 2020 to 2060 target date funds, they are mutual funds. And what mutual funds are companies. They take money from investors and then they invest the money in securities like stocks, bonds, and short-term debt. So with that total portfolio of the mutual fund, the total portfolio of the mutual fund, sorry about that. So the total portfolio of the mutual fund will consist of, for this one, it will consist of stocks, bonds, some fixed income assets. When the shareholders own mutual funds, they own a piece of the mutual fund. So if you go and you buy this 2030 target date mutual fund, you actually own a piece of the mutual fund. So you own a little bit of each one of those stocks, bonds, and fixed asset that are in the mutual fund. So you see here, for right now, 68% stocks, 32% bonds and cash. It does taper down and then it becomes stable later on. Asset allocation of fund. You see that 68% equity or stocks, 18% fixed income, 14% cash. What you want to look at here, you want to look at your top holdings. The top holdings are the stocks or bonds that are in this mutual fund. So as you see, we got Microsoft, Apple, Amazon, Facebook, Berkshire Hathaway, Johnson & Johnson, Alphabet or Google, ExxonMobil, JP Morgan Chase. You see the percentages of each fund. So this fund has 1.2%, Microsoft, etc. The number of holdings or the number of stocks, bonds, fixed income that are in this is about 21,000. They want it to be very stable for you. They do not want you to lose money going into retirement. So other stuff you can look at are the net asset in billions of dollars, the portfolio turnover, how much of it gets sold per year. A lot of this other stuff is important if you go for just buying just single stocks. But since these are mutual funds and they're probably hundreds of times safer than any individual stock, we won't really go over that. You can go over that in your own spare time. Top industries for the fund. You see there's financials, 11.04%, information technology, healthcare, industrial, consumer discretionary, communication services, consumer staples, energy, material, real estate, utilities. So what it's saying is these mutual funds, they'll have stocks or bonds or fixed income, but they'll have it over a few different industries. That way, if financials are taking a hit, information technology might be doing good. So the overall fund won't go down as much. It's going to be, unless the whole stock market is crashing, it's going to be rare that financials, information technology, healthcare, industrials, consumer discretionary, it's going to be rare that they're all declining at the same time, unless the stock market is decreasing or crashing. So they spread your risk over multiple industries so that pretty much in the long run, the mutual fund continues to gain in value, which means more money in your pocket for retirement. Okay, bond types. You see they got government bonds, corporate bonds, mortgage-backed securities, mutual bonds. Last video, we went over credit quality. Credit quality, you want to stick with the AAA bonds, AA, A, BBB. Those are your least risky bonds. They also have the least return because you have to take less risk. When you get further down, CCC, CC, D bonds, those are your riskier bonds. They normally offer a higher return because you have to take a lot more risk. The risk you have to take is that you won't get your money back if something happens to the bonds. Maturity breakdown. So how long each fund goes until how long, it's pretty much the duration of the fund, each bond. Geographic breakdown. So 69% of the stocks or bonds or fixed incomes are from the United States, 10% from Europe, 5% from emerging markets in Asia, 5% Japan, UK, etc. Management. On any fund, make sure you pay attention to the management. That way, you know, if you hear something, if you know who the management is, you start hearing bad things about the management on the news, you can try to get out of that fund so you don't lose all your money. But it's pretty rare that these funds have a lot of issues, but you never know. Look at the management, look at the objective. You can read the strategy. Each fund has a different strategy. Make sure you read the strategy so that you become familiar with it. The risk, these mutual funds are not that risky. That's why people like them, because they spread your risk over multiple industries. You see this one had like 21,000 holdings or 21,000 stocks, bonds, fixed income avenues. This is a very stable fund. It'll be very good if you're getting closer to retirement. So just read over that if you want to be more familiar with that. There's also a glossary back here. Any terms that you don't understand, just come and look at them in the glossary. It will explain it more to you. If you need more explanations, just try to Google what all of these words or phrases are. But I pretty much gave you the overall view of the 2030 target date. We'll keep on with more of these tutorials. Make sure you comment, ask your questions. We will make more videos to answer questions and to address any concerns. Enjoy.